One of the most used metrics for comparing commercial properties from one from another is ROI, or return on investment. Basically is net profit divided by the total investment price. It allows you to compare potential investment opportunities, evaluating the financial viability of a specific property, assessing the risk, reward trade-off for investment, and also for attracting investors and securing finance for a project. But there are other metrics besides ROI when determining whether to go ahead with an investment property. Let's go through a few of them. ROI versus cap rate. ROI, return on investment, considers the total return including appreciation, while cap rate focuses solely on income. ROI can be calculated for any time period. Cap rate is usually annualized. Cap rate is more standardized for comparing income-producing properties compared to cash on cash return. ROI uses total investment cost. Cash on cash uses only cash vested. Cash on cash better reflects the impact of leverage. ROI includes property appreciation. Cash on cash focuses on cash flow. Return on investment compared to internal rate of return, IRR. Internal rate of returns, IRR, accounts for the time value of money. ROI does not. IRR is more complex to calculate but provides a more comprehensive view of returns. Return on investment is simpler and more intuitive for quick assessments. Net present value, NPV versus ROI. NPV provides a clear dollar value. ROI, on the other hand, gives a percentage return. NPV accounts for time value of money. ROI does not. NPV is better for determining if an investment adds overall value. ROI is better for comparing relative profitability. The key takeaway is, while return on investment provides a simple and intuitive measure of profitability, it's often used in conjunction with other metrics to provide a more comprehensive analysis of commercial real estate investments. Each metric offers unique insights and is suited for different aspects of investment evaluation. ROI is of a dynamic nature in commercial real estate because variables change over time. It is important that you keep monitoring the market and adapt investment strategies accordingly. Acknowledge you need a tailored approach to ROI analysis based on the unique factors affecting different commercial property types. For example, comparing office to retail to industrial to hotel and tourism projects. Situations where, ROI in the current situation or time when you had, for example, offices. Offices were good investments 5-10 years ago. Then we had a thing called pandemic, which meant that people weren't working in the offices, had to work from home, or more than half the office population disappeared and consequently reflected in the returns. Now, this looks like changing. People are going back to the office situation. Whether we go back to what we were before COVID or beyond that, we don't know. But that would change in time as well too. How you assess it depends on how things change in the future. Same thing with retail. People were buying more things online, and obviously there are a lot of vacancies in the retail situation because of the pandemic. Now, again, retail looks like it's coming back again, so maybe we'll flavour of the month soon. We don't know. Industrial went the other way around. That appreciated a fair bit. Return was much better because there was a high demand for warehouse space because people were buying things online, and returns were getting better. Now, what's happening now? There's a growing demand for industrial space, and as you get demand, it's reflected in the prices. So the return becomes less and less. How that pans out, we don't know. Whether it still is a flavour of the month in 6-12 months' time, we don't know. Maybe offices may be better investment, or retail. Another situation where we had hotels. Hotels, no one was travelling during the pandemic. A lot of hotels in the past have been changed, converted to apartments. Now the borders have opened again. People are travelling more. Tourism is growing, and demand for hotel accommodation is increasing, and there is more investment in that area. because the returns are getting better. Location is important with return on investment. Location impacts key factors such as rents, occupancy, expenses. Rents, maybe there's a growing demand to move in the area, rents increase. Maybe there's a new zoning or changing demographics or a new development close by, which brings in high demand for maybe there's more residential property coming into the area, more people around, people are eating more, buying more, spending more time in that particular area in the retail situation, the environment situation. Now, whether the environment is getting worse or better, maybe there was a factory nearby which had a lot of pollution and it disappeared, or an antenna around, or some electrical pollution, and things have been removed, and the area is becoming more appealing because to the families, because there's less pollution around, it's a cleaner air situation. That could affect ROI. Environment, and also expenses. They're affected. That could change. For example, you may have property which is close to the water. Salt spray causes damage to the buildings over time. You've got to factor in the extra costs involved to maintain the property. Maybe it needs a certain energy source, like more electricity, which is getting more expensive. And so as a percentage of other costs, a high expense. So that'll affect return on investment as well too. There are also ethical considerations in commercial real estate. There's a growing importance on environment, social and governance factors. So they have to be taken into account. So basically, you've got to take all these things into account, determining return on investment, ROI. If you have any comments, like more videos like this, subscribe to this channel.